Okay, let's continue. So basically, the cost of capital illustration 1 to illustration 4, they lay the foundation. And actually, it is you can say that it is the most difficult part to explain and also understand. So we have done the hard work. So we are now going to enjoy doing questions. You will find it AFM is I would say that the best subject that designed by the ACCA in the whole of ACCA because it's so interesting and it is also so practical. I have chosen the correct option paper. Study, it is a bit challenging, but passing exam is relatively easy because you can notice that the syllabus is very focused. It's unlike your F9, which is very wide. So AFM is very focused. Of course, it go into very deep, but it's manageable. So exam, I can say that is relatively easy. Study is just a bit challenging, but it's extremely interesting. Extremely interesting. So like I say that I go through this subject here very systematically, lay the foundation first, and then slowly bring in more and more things. Okay, so we begin with the illustration number 5. So this illustration is using nominal cash flow approach. And this is a classic illustration. So if you are able to follow illustration 5 on nominal cash flow, practically you can do any questions on nominal cash flow. Very good questions. So we're going to apply the step 1, 2, and 3, plus also we're going to apply what we have learned in the cost of capital calculation, especially the asset beta formula, and see how you applied it. Okay, so maybe we can look at the requirement first. Okay, always is good to look at the requirement first. So you may assume that risk-free rate of interest is 7%. So the moment you see risk-free and also market return, most likely will be using capital asset pricing model. Now notice this is a market return. So market return, you minus a risk-free, only give you the risk premium. So the risk premium is 14 minus 7. Okay, it's also 7%. Taxation 30% payable 1 year in arrears. So your tax, there's a delay of 1 year. So if it's a 5-year project, you have to do it until year 6, add 1 more year. Add 1 more year. Okay, and then advise director of PLC if it's financially viable. Now in the exam, they may not tell you it is NPV or APV. It's up to you to find out whether it's NPV questions or APV questions. So is it financially viable? They say they expand the 2 productions. So this is a business expansion. Business expansion. Financially viable is always using present value method if they don't mention. So it's either net present value or adjusted present value. So I just highlight to you why is it net present value method. Why is it net present value? I just highlight for you. You learn after that. Okay, so that is step number 1. Why NPV method? Gearing no change. Gearing no change. So it is put in here. Financial gearing of PLC not expected to change with the expansion of 2 productions. So that is normally I say step 1. Find out. Okay, and then the second thing is which approach, right? So which approach? Normally we can just look at the inflation, right? So you see that there is a 5% inflation, and then there's a 6% inflation. That means there are two inflation here. Two inflation, you definitely cannot use real cash flow because one inflation, one discount rate under the real approach. Okay, so if you see two inflation, then actually it is a nominal, step number 2. Or alternatively, you can see that the equipment will have a scrap value after 5 years. That means this equipment or this project here only for 5 years, short-term project. Step 2, and then lastly, we have to extract out the cash flow, right? So your justification, remember, using NPV, you just mentioned that because the gearing remains unchanged. That's why you use net present value approach, all right? Okay, let's look at your questions. Now, normally your question, they are quite structured. Your examiner is a super good examiner. The question is very structured, all right? They group together the capital cash flow, they group together the operating cash flow, and then they also group together the cost of capital calculation. So you try to recognize a pattern here, all right? So they started out with the capital cash flow actually. They started out with capital cash flow, right? So they say that PLC has two main business here. That is a jack and also the tool here. Two main business here. So of course our concern is the tool. The tool expand the tool productions. Okay, so bear in mind. And then they say that the company is considering expanding the tool business. So business risk remains the same. The investment here, it is equipment. So this is a capital cash flow, 200,000. Okay, and this is tax allowable, 25% on the reducing balance basis. Your tax allowable depreciation is either reducing balance or straight line. Straight line meaning to say every year is the same. Either straight line or reducing balance. If there are special tax allowable depreciation, they will mention to you. Sometimes they even give you the allowance for each year. Okay, so this equipment here is tax allowable. And the equipment will have a scrap value of 40,000 after 5 years. So that is a cash flow for your equipment. So what is the effect of this investment here or this capital cash flow here? Your tool production, annual production of tool. That means every year. Okay, because of this equipment here, it will increase by 70,000 units. So your revenue going to go up. Of course, there are associated variable costs will go up also. So will last for the next 5 years. So this 70,000 here, it is your operating cash flow. Operating cash flow. So we have to wait for the selling price, etc. Okay, so tax allowable depreciation in the exam for the spreadsheet, you can use TAD. Spreadsheet, you can use shortcut. But when it comes to writing your word processor, you must write proper. Okay, so TAD is acceptable. Acceptable. You can see in the ACCA suggested answer is also put down TAD. Right, so that is one capital cash flow here. And then is tax allowable. And then you also have investment in working capital. Okay, so expanding the production will call for increased investment in the working capital. And they actually say that, which indicates that at the start of each year. So this is normally for working capital, it is always when you start of the year, start of each year, right? So investment in the working capital will need to be 7% of sales revenue for that year. So for the operating cash flow or sales revenue here, normally it is end of the year, end of the year. And the working capital will be the start of the year, start of the year. All right, So move on. So you have two capital cash flow here, equipment and working capital. Then you have operating cash flow here. Selling price of Garden 2 is $7.8 per unit. And this $7.8 is current price. Current means year zero. You have not adjusted for the inflation. So the first sales should be 1 year from now, year one. Okay, variable cost also at current cost at year zero, 5.7 per unit. So selling price inflation is 5%. The 7.8, you have to adjust for 5% after 1 year. After 2 years, you have to adjust for 2-year inflation and so on. No increase in existing fixed cost is expected. Okay, so your operating cash flow only two, sales and your variable costs. No fixed costs. And they purposely put down here incremental annual interest cost is 11,000. This one is irrelevant because this interest cost here already incorporated in the discount rate. So in the exam, you have to explain why you didn't include the interest cost. Okay, because it's irrelevant, it's already included in the cost of capital calculation. So that will be your discussion marks. Okay, So two capital cash flow, two operating cash flow, and then for the equipment, your tax allowable depreciation. So your setup should be something like this. Start with your operating cash flow, sales, variable costs, and then you have to minus the tax allowable depreciation. Okay, So sales minus all the costs, you get the operating profit or taxable profit. Handle the tax, delay 1 year, and then you add back the tax allowable depreciation because what you want is cash flow. Right, followed by capital cash flow, equipment and working capital. And then from here, add until here, that will be your net cash flow. And then you can use the NPV function to get the NPV. Okay, you can present as a present value, discount rate, and so on. But this question just asks you financially viable or not. Don't waste your time. Don't waste your time. Okay, you can use a function. But when I present two for you to let you know, okay, that is a function is correct. Okay, so you have learned earlier the IRR function. Now you also learn NPV function here. And then, of course, we have those working below here, which I will go through. And then you see that the cost of capital, you have to calculate also. You have to calculate those costs of capital also. Okay, so I will show you in the spreadsheet. I'll show you in the spreadsheet. So let's go to the spreadsheet. So let's bring it down here. So I always practice using spreadsheet. Okay. So you can put it as your calculation as an appendix. Okay, then you explain in the word processor. So I'll start with the operating cash flow. You need to come up with the sales, and then you have the variable costs. And you have to minus the tax allowable depreciation. No need to be capital letter. Don't waste your time. Okay, so tax allowable depreciation, and you can put taxable profit or operating profit, or both also can. Operating profit, then you follow by the taxation. And then you can add back the tax allowable depreciation. And after that, you can follow by the capital cash flow, the capital equipment. And in the capital equipment here, you can put the scrap value also. Okay, then followed by the working capital. Right, So after that, you have the net cash flow. You notice that I will just lay down the item first. Okay, I will never do calculation first. I put down all the item first because all these items we put down, they are marks there. Okay, so let me also show you that is if I were to use a discount. Okay, I show you both. For this question, I'll show you both. So you go to discount. Okay, at the WACC, right? And then you get the present value, and then you can get the NPV, right? So for this question, actually, I will not use this one here, but just for the purpose of showing you, that's all, right? So you may ignore these two here. Okay, then you can straight away get the NPV also. So remember that I will leave the column B, okay, as working or put the notes, etc. Okay, so my calculation will normally start with the column C, column C. But you stay flexible, just a suggestion only. So 5 year, 1, 2, 3, 4, 5, and then plus 1 year of taxation. 1 year of taxation. Okay, so if you remember, just make it easy. Inflation for selling price is 5%, variable cost is 6%. Okay, just to help you, also maybe put a note to the marker that is inflation. And taxation, it is 30% as in the requirement. So you can put down here 30% here. Okay, and then you can start filling in. Fill in. So you can work in terms of thousands or millions, up to you. So let's say that it is 200,000. We can have 200,000. You can put it as 200,000 if you want to. Okay, so I just want to be consistent of what I give it to you. So I do it in terms of dollar. Okay, that's fine. But actually, it's better to do in terms of 1,000 because you save keying in 30. But because I presented here, it is in 1,000. So I just show you the same. Okay, so that you can compare later on. So let's put in. The one that is no need calculation, put in first. Equipment is 200,000. So I put down here 200,000. And then the scrap value at the end of this is minus outflow, 200,000. And then at the end of 5 years, there's a scrap value of inflow of 40,000. So this will be giving you straight away the marks. Straight away the marks. Okay, and then we can, if you want, you can say quite flexible. You can come up with the discount rate if you want to. Very flexible, whichever that you know. Whichever that you know. All right, so I do the discount rate later on. So it looks to be easier to do the sales. Cut down your working. Cut down your working. Straight away do your working here. Because if you do your working for sales, you put it down here. Let's say you put down here for sale, then you have to go up and down, up and down. That wastes a lot of time. And it's also not good for the marker. The marker also have to go up and down, up and down. They find it very irritating. So if you do your working here, and you don't have to go up and down, and you save a lot of time. All working is shown there. Okay, so let's look at the sales figure. Year 1. So always at the end of year 1. So selling price right now is 7.8. After 1 year, it should be 5% more. And then your production will increase by 70,000. Okay, so that will be the incremental sales revenue. Incremental sales revenue. So you just have to put 7.8 multiplied by 70,000 units. Okay, And then the 7.8 is current. I can multiply by 105%. 105%. Okay, huh? So that will give me the price in year 1 times 70,000. That is my working already. I get 573,300. 573,300. So I have my working there. Then I go to year 2. So year 2, the selling price will be 5% more, which actually is year 1 selling price. I multiply another 105 only. Okay, yeah? So subsequently, they are all the same. I can just equal the one before. I multiply by 105% only. There will be just 5% more. Sales revenue go up by 5% more. And after that, all the same, I can just copy and transfer to copy. I make sure I copy, copy, and then I paste it to 3, 4, and 5. Control V. I get the rest of it. So the same go for the variable cost. So variable cost is 5.7 current. So you'll be 6% more 1 year later. So 5.7 minus, so it's minus 5.7 multiply 106% and then multiply by 70,000. So that will be the variable cost. And then after that will be just 106%. So multiply 106%. And again, you Control C and then Control V. Oh, sorry. And then Control V, okay. Sometimes press wrongly, So then you have Control V there. So we have finished with the operating cash flow. We now handle the tax allowable depreciation. So you can just put in column B here, working number 1. And of course, we can put down here, working number 1. So this will be the tax allowable depreciation for the capital equipment. I can put down here, it is capital equipment. Okay, so it's on the reducing balance. This is the allowance. We need to have a balance or the reduced balance there. Okay, so let's look again. The tax allowable depreciation is 25% on reducing balance. The first allowance we normally assume is in year 1. Normally we assume it's in year 1. Okay, your equipment is 200,000. At the end of 5 years is 40,000. Okay, so we can put this one here down. That is again, this is a year 0, 1, 2, 3, 4, and 5 here. All right, so this is a 200,000 equipment here. 200,000. And then you have a reduced value of 40,000. So the first year we don't claim, we only claim at, the year 0 we don't claim, So this will be a balance of 200,000. A balance of 200,000. Okay, so this is on 25%. 25%. So we will have the first claim. If it's silence, you just make your assumption clear. Okay, we assume that tax allowable depreciation start in year 1. All your writing. Okay, this is all your working on it. So equal to 25% of the balance in year 0. 25% you multiply by this balance here. So you will claim 50,000 here. And at the end of year 1, after you claim 50,000, what is your balance? Should be the one before you minus this allowance here. So this balance here is now reduced to 150,000. Okay, then after that is still the same 25% on this amount here. you can just copy, oh, sorry, equal 25%, times this one here. So you can just copy, Control C, and then paste it until year 4. Okay, so this will be 25% of this figure. And then the new one will be this figure minus this one, which is just copy this one here. So you can copy and then paste until here. So you get the rest of the figure. You learn. You learn. So all your working is shown there. All working shown there. All right, So you can check this 25% of this figure, this 25% of this figure, and so on. And come to year 4, you still have 63,000 not claimed. And then you sell off for 40,000, you claim the balance. This is your balancing adjustment. Will be equal to 63 here, you minus 40,000 here. So you will have 0 balance to claim. So if you add up all this allowance here, it's actually 200,000 minus 40,000, which is 160,000. You can check. This total up together will be 160,000 you claim. So this is known as your reducing balance method. Learn it, Okay, so this allowance here, you can claim to reduce your profit. Then you save 30% on the taxation. You save 30% on your taxation there. Okay, So let's put it down there. So you can have D of 32. Okay, D of 32. Put it down there. So equal to D32. Sorry. Or D30, sorry. D30, or you can just straight away copy. So D of 30, okay, 50,000 tax allowable depreciation, and then after that, you can just copy and paste it over the rest of the allowance. So we can now come up with the operating profit. So this one should be minus actually, minus, tax allowable depreciation, minus. So you need practice lah. Sometimes I also forget that you have to put the minus there. So operating profit will be just sales minus this one, minus this one. So you just have to sum it SUM, and then you sum it from the sales to the tax allowable depreciation, and enter, you have 100,360, and then the rest will apply, copy, and paste it over. And this one, tax allowable depreciation here, you can just equal to D of 30 lah. Just now I know, positive figure lah. So copy and then paste it over. So then I have the taxation here. So taxation will be 30%, but delay 1 year. So I have to put 1 year after. So this 100,000 here, the tax will be here. So tax you have to be minus 30% multiplied by this operating profit here, 1 year in arrears. Okay, so then you can now copy and then paste it to year 6. Those are the taxation. And one last one, then we are complete. Okay, at least for the cash flow. Working capital, we can do as working number 2. So my working, they are quite short, actually. Working number 2, this is working capital. All right, so let's read again. So investment in the working capital, which indicate at the start of each year. All right, investment in the working capital will be 7% of revenue for that year. So 7% of the sales revenue. So this is year 0. This is year 0. This is year 1. Okay, So we say that 1 year actually is end of the first year. End of the first year. Year 0 was the start of the first year. So your working capital should be at the start. So it is 7% of this sales here. We put the working capital you require in year 0. In year 0. All right. So let's work out what is the working capital requirement first. Okay. So maybe I just copy this one here and paste it over here. In fact, you don't have to do that also because this is already a year 0. Anyway, okay. So this is your working capital you require. So it should be 7% you multiply by the sales revenue. So you multiply by the sales revenue here. So it's 40131. After that, you can copy until year 4. Okay, that is at the start of year 5. So copy and then paste it. And then after that will be your how much working capital you have to put in. Okay, year 0, you require 40,000. That's why when you start the project. So of course you have to increase your put in working capital of 40,000. And then come to year 1, you require 42,000. That means it's just 2,000 more. You have to put in another 2,000. So I will normally put it down here as this figure minus this figure. So that will be incremental of 40,000. Okay, for shortcut lah. So this is your working capital in year 0. So it will be equal to, okay, so I will take this one here is 0. I minus this figure. So you will have an incremental of 40,000. After that, will be just copy and then paste it over. I get the rest of the figure. Okay, you have to increase another 2,000, another 2,000, 2,000, and so on. At the end, you get back. Normally, we assume that you get back your working capital. They never mention here, we assume you get back. Whatever working capital you put in, you get back. So this put in, and you're going to get back, it should be the sum, and then it must be positive. So I will have equal to minus the sum. That means I turn into positive, sum of whatever that you put in. They here until here. So you actually put in 48,779. So there will be at the end of the project, you get the inflow of 48,779, which of course is the last figure. It is this last figure here, 48,779 here. Because at the start of year 5, you require this amount. And then you get back this one here. Okay, So we have completed all the cash flow. So we're now going to come up with a discount rate. Okay, so you notice that we adjust for the inflation 5%. This is nominal cash flow. We adjust for 6%. That is a nominal cash flow. So we're going to come up with the cost of capital. So let me put this one here as working number 3. So nominal cost of capital will be just using the formula. We will go through systematically equity capital, debt capital, cost of equity, after tax, cost of debt. These 4 components here. That's where it get interesting. That's where it get interesting. Okay, So let's look at your information. And we have to apply whatever that we have learned. So your examiner is very structured. It gives you capital cash flow. It gives you operating cash flow. It tells you about the tax allowable depreciation. And then in another part, they will tell you what is the cost of capital. Normally, it will be at the end. Your financing there. So let's look at your information here. Company overall beta is 1.3. Company overall equity beta. Remember, equity beta is business risk and financial risk. And the business risk has to be Jack and 2. Jack and 2. And our evaluation is only the tool. That's where you get interesting. You have to be clear first. Right? The average equity beta in the Jack is 2.31. So they tell you what is in the Jack. They never tell you what's a tool. They only tell you what is a Jack here. 2.31. Okay, you can think of it as another company in the Jack industry. So of course they have to tell you for the 2.31 equity beta here, what is the capital structure. So they say that it's 50-50. 50-50. So we have that in mind. Okay, then no other information already. That's all they give you. But what we want is what? What we want is a tool. What we want is a tool. In fact, we want to find out what is the cost of equity for the tool. For the tool. All right, gearing no change. So they give us a financial position here. Bonds, 12.5%, undated. Undated. All right, So this is a total par value. One bond, it is $100. This is a coupon rate. So we have to make use of what we learned in the after-tax cost of debt. The first method, the undated or irredeemable, and then the share capital, 700,000, 25 cents par value. So from there, we can get the gearing or capital structure. Company's ex-dividend share price is 1.62. So we can get the equity capital. So we must have a way to systematically come up with the cost of capital. Even I know it's NPV method, I must still come up with the cost of capital. Okay, So share price multiplied by number of shares. That is the equity capital. And then we will also know this bond price is 125. 125 means 125% of the par value. That means it is $125. $125. Okay, So I can multiply by the number of bonds here. Or 125% on the total par value also can. Right, Jack and 2 business represent 40%. Jack is 40%. The 2 is 60% of the company, of the market value here. So that's all they give you. Right, I can always get part marks. And then I have some time to think about it. How do I get those things there? What must I get? What must I get? That's where the 4 components come in very handy. Very handy here. Okay, all your questions can be approached this way. So I know these are the things I have to calculate. So equity capital, I just get my marks first. That is 1.62 multiplied by the number of shares. Equal to 1.62, I multiply by the number of shares. That is 700,000. Okay, you can put into the thousands, or you can put into the millions, or you can put into the dollar also can. All right, So let's say that we put into 700,000. Put into dollar here. And then there are how many shares? One share is 25 cents or 0.25. So they give me the number of shares. So that will be in terms of dollar. 1.62 multiplied by number of shares. I can just enter. This is the equity capital. The next thing I know I can get the marks is I want to know what's the market value of the bonds. So it's 125. Every $100 is selling at $125. This is the total par value, 1320. I can just simply multiply 125%. That means it's 25% more. Okay, so I can get the market value. So I can approach it this way, 1320. So 1320, and then I can just multiply 125%, just 25% more. Or you can just come up with the one bonds is $125, and then you multiply by the number of bonds also can. Okay, so I show you another way, that's all. So this will give you the debt capital. I change this one to the percent. So this will be 4.536 here. I over the total capital. That is over equity capital plus the debt capital. So this is about 73%. The debt must be around 27%. 1 minus this one here. So about 27% there. Okay, then I can find out what is the cost of equity. And then I can find out what is the cost of that. Let's see what is the cost of that here. So it'll be easier for me to calculate what is the cost of that here. Okay, so 12.5%, if I multiply by 100, is $12.5. $12.5. So it is an interest payment. Then I divide by the price, 125. That give me the interest rate, irredeemable. So you have to be very familiar. So $12.5 over 125, that's an interest rate. Then I just have to net off the tax of 30%. Okay, so let's put in. So this after tax cost of that should be equal to 12.5%. I show the working here. I multiply by the par value of $100. That's $12.5 over $125. That's a market value, the bond price. And then I can just net off the taxation. So if you are not sure, of course, you can always put the bracket safer. So that will be the $12.5 interest rate there. And then I can just net off the taxation, multiply by 1 minus 30%. All working in the cell. Very, very neat. Very neat. So this will be the after-tax cost of that there. Okay, so of course, if you want, you can always, one time you have a percent there of 2 decimal points, that's fine. So I have this one here, the 7%. Last one. If you find it, you cannot get the cost of equity, never mind. In the exam, if you run out of time, you simply assume one figure. Simply assume one figure. Of course, that figure must be more than 7%. So once you assume one figure, examiner will only don't give you the marks here. So the marks here may be 1 mark only. But based on the wrong one here, they have to give you full marks in the cost of capital. Because ACCA will only penalize you in one place. The rest of it, if you can show that actually it's the average of these two here, they give you full marks for the cost of capital. And then if you put in the cost of capital here, they also will give you full marks. And NPV also give you full marks. Even your answer is different from examiner. ACCA got one rule, which called it own figure rule. They only penalize you one part only. The rest, they have to give you full marks. Even the conclusion, you based on the wrong NPV, they must give you full marks. So methods become very important. Steps become very important. Even if you don't get this one here, it's perfectly fine. You must know, okay, cost of capital is the average of these two. Example, let's say that this is, you assume it's 15%. You don't know the answer. You just put there, you assume it is 15%. Okay, and then you work out this one here is equal to the average of these two here. So it will be proportion of the equity multiplied by cost of equity plus proportion of the debt multiplied by the after tax here. And you get 12.86 example. You get this one here. All right, So then the examiner must give you full marks on this one. They must give you full marks on WACC, equity capital, debt capital, and also the after tax here. They may take away 1 mark here only. Okay, and then you use this one here, 12.87. You go and calculate the discount rate based on the working number 3, they will also give you full marks here. They will also give you full marks here. Okay, and NPV, they also must give you full marks here. So you see that actually, if you know the format, you know the steps, it's relatively easy to pass AFM, because then you can start writing the report in a word processor if it's a report format. All right, so you understand that, that is called own figure rule. Own figure rule. I put it down here for you, own figure rule. That means ACCA say that whatever you do after that is based on your own figure. It's not based on ACCA figure. Own figure rule. Okay, OFR. OFR there. All right, so I now work through with you. Okay, how to get the cost of equity. Remember, to calculate cost of equity, there are 3 methods from the mind map number 2. Growth model, capital asset pricing model, and Modigliani and Miller. So you see the question talk about beta, then it must be capital asset pricing model, if the beta given there. Okay, so let's look at the information again. Very interesting, this one here. So if you know this one here, actually you can do any ungearing, regearing, and any question. Most of the question will be of this format here, right? And I suggest in the exam, you use the scrap paper. They will, if you go to the exam hall, they will give you scrap paper and they give you pencil. You draw, you draw it out, All right. Let's start drawing, Okay. Overall equity beta 1.3. Overall is a PLC here. The equity beta is 1.3. So let's draw it, Let's draw it. So let me just draw it here. Okay. So this is the PLC. I put it down here, PLC. And then the equity beta, you draw it very fast, So this is equity beta is 1.3. So that is the information I have there. And then they say that the average equity beta in the JAC industry is 2.31. So they tell you about the industry. And we also know that the company has got 2 business, JAC and 2. Let's put down this information. Okay, so we have this one here. They have 2 business. Okay, and then one, it is a JAC. The other one, it is a 2. So this is a JAC. And then also you have the 2 here. The 2 there. And they actually tell us in the JAC industry, you can think of it as another company. Another company. So this is the JAC and the 2. So I put it down here, the industry. So the industry, they say that the equity is 50%, and then the debt is 50%. And the equity beta, they say that is 2.31. So I put down here, equity beta is equal to 2.31. Okay, so that's the information I have. JAC industry, equity beta 2.31, gearing is 50, equity 50% debt. So I have this information, I have this information. And then below here, you have 2 is 40%, JAC is 40%, 2 is 60%. So I have this one, put it down here. The JAC is 40%. And then the 2 is 60%. That's all they give. What do we want actually? What we want actually is to find out what is the tool here for the PLC, and we want to calculate the cost of capital, we need to know actually what is the equity beta for the tool. Equity beta for the tool. Remember that. All right, huh? So what we want is this one here. This is what we want. So that's very clear. That's very clear. Okay, huh? How do we go about it? Think of the beta. Think of the asset beta formula. Okay, we want to get at the end the equity beta. So of course, it will be some kind of regearing. Some kind of regearing. We have to make use of asset beta formula because equity beta not given. It's just like our illustration number 4. Illustration number 4. Okay, so PLC, 40% is jack, 60% is tool. So we can assume that the jack will have 40% of PLC's asset. Tool is 60% of PLC asset. So we can use asset beta. We can use asset beta. Okay, so what we can do is, first, we will have ungearing here. This is equity beta for the whole company. Okay, so first thing we can do is, we can find out what is the asset beta here. We can find out what is the asset beta here. All right, and then, of course, in the industry here, the equity beta also given. So from the industry, we can also find out what is the asset beta. We can find out what is the asset beta. So the whole company's asset beta, and then you have the jack asset beta, jack business asset beta here. We can assume that the whole company's asset beta is an average of these two asset beta. Okay, so once we get this asset beta here, we get this asset beta, of course, for the jack, it should be the same also. Okay, we will then get the asset beta here by taking the weighted average, that is 60% and 40%. So then we get this two asset beta. And last, then we use a formula again, we get the equity beta. So I repeat, we can do an ungearing to get asset beta. We can do an ungearing to get the asset beta for the jack. And then we can take the weighted average, we get this asset beta. And then we do a regearing. After we get the asset beta, we can do a regearing, we get the equity beta. So using asset beta formula 3 times. And then using the average here once. You don't have to draw this diagram here. You need not draw this diagram here. Okay, so you can see the question can become very interesting. So you need to be extremely familiar with the asset beta formula. Asset beta formula. Okay, so I would need to get the tools equity beta at the end. All right, so let's have this one here as working number 4. Or if you don't want, since this is already working number 3, if you don't want, I can just put down as a 2 asterisk here. As a 2 asterisk. That is follow from a work, still in working number 3. So I want to get the tools equity beta so that I can put into the capital asset pricing model. I get the cost of equity. Cost of equity. Okay, so I can get the PLC's asset beta first, or jack asset beta also can. PLC's asset beta, let's do an ungearing, and then I can get the jack asset beta, again an ungearing, And then after that, I can get the tools asset beta. By using the average here. Okay, I can put down here using the average here. And then lastly, I can get the tools equity beta. Tools equity beta. So very familiar, huh? Most important thing. You practice, actually, if you practice, you come very fast, extremely fast. All right, okay, let's go into the PLC's asset beta. PLC's asset beta. Okay, so this asset beta is 1.3. This equity beta is 1.3. So what is the capital structure of PLC here? So the capital structure of PLC, we can refer to on top here. This is 4536. This is 165, or you can use 73 and 26 here. Okay, so the asset beta, remember, is follow that formula. So again, remind you, to find out the asset beta, always use a mind map lah. Always a mind map, but for my convenience, I just refer to here. Assume that beta equal to 0. They never mention, so this has to be assumed in a word processor. Equity plus that, net of the tax, and then you have the equity beta, okay, which is 1.3 there. So you showed it here. The PLC's asset beta should be the equal to equity. You can click here. You over, and then equity plus that. These are all your working. And then you net off the taxation. Taxation is equal to the, sorry, just want to make sure. So the taxation is equal to the requirement of 30% there. Okay. So multiply by 70%. And then we can close it. And you can then multiply by the 1.3. So we get the company's asset beta. We do an ungearing here. Ungearing here. So I got hold of this one here, 1.036. 1.036 here. Okay, so then I can find out what is Jack's asset beta. Now, once you do this one here, actually you can just copy and then change a figure if you want to. Okay, I can just copy and then paste it here. Cannot, there's a way to do this one here. Let me just equal to this figure here. Cannot. 1 point. Okay. I remember I can do it here using the formula. Should I just copy this one here? If I copy this one here, I just try that. So sometimes a long time never use, also I forgot. Cannot also, but actually it can be done. Okay, never mind. We just follow the same. So Jack's asset beta will be just equal to the equity, which is 50%. You can just put 50 also can. Equity, and then the equity 50% plus the debt is also 50%. Of course, we assume the industry is also 30%, so multiply by 70%. And then you multiply by the equity beta of 2.31. 2.31. So we get the Jack asset beta, Jack business risk there. So that is 1.358 something. Okay, so after that, then we can get the tools asset beta, the tools asset beta, right? So maybe better I put it down here for you so that you know what I'm doing. So I'm just assuming it is an average. I'm assuming it is an average. So the asset beta here should be equal to, okay, so that is the PLC's asset beta. PLC's asset beta is a weighted average. Okay, that is 40% of the Jack asset beta, and then plus 60% of the tools asset beta. So this is a weighted average, 60 and 40, 60 and 40. So the Jack asset beta I have, the PLC asset beta I have. We have just do ungearing here. We have just do ungearing here. So we are left with this one here only. Okay, yeah? So we will have the PLC's asset beta minus 40% of the Jack asset beta, and then we just divide by 60%. All right, that is an average. So I straight away present it there, that's all. Okay, yeah? So this one should be equal to the PLC's asset beta, and then I minus 40% multiplied by the Jack asset beta, and then the whole thing I divide by. So I put a bracket here. So the rough paper become very useful. So yeah, if you are not able to keep in your mind, you have draw it in your rough paper, and then you present it this way. So divided by 60%. Then you will have the tools asset beta. Lastly, you use an asset beta formula again. Okay, to do a regearing, then you get the equity beta, right? So lastly, you want to find out what is the equity beta. So you already know the asset beta is around 0.82, and then you have this capital structure here. We have no choice. We have to assume it is the same as a company. We have no choice because no information is given. We have to assume that the tool and also the Jack will follow the same capital structure as a company. So that is the assumption. All these are your discussion. Okay, all these are your discussion. All right, so we have to assume it is the same. It is the same there. So equal to, so the asset beta, and then we multiply by the capital structure as for the company also. So it should be this figure here, equity, and then plus the debt, and you have to multiply by 70%. Okay, and then the whole thing, then you have to divide by the equity, which is 4536 here. So that will give you the equity beta, 1.03. 1.03. So be very familiar. This question is very interesting. Very, very interesting. That's why I say that in the cost of capital calculation here, asset beta formula you use 3 times. You use asset beta formula here, you use it here, lastly also you use it here. Okay, this is, you can say this is the most complicated one. Practice, memorize a formula. Okay, and this is a classic question for nominal cash flow, a very, very good illustration. So equity beta for the tool we already have, we can now put into the capital asset pricing model. That is 7%, market return 14%. You can show the risk premium as 14 minus 7, right? So we just put that in. So then we get this figure here. So the moment I change this figure, everything changes. So equal risk-free 7% plus equity beta for the tool under all our assumption is 1.03. And then you can multiply by, you can put it as 14% minus the 7%. So the risk premium shown here is 7%. Okay, so then we get the 14.21, and of course this cost of capital automatically change. Automatically change here. So in the exam, you can keep it as 12.29. You can put it at 12.29, or of course, I want to be same as my printed answer there. I just put it down approximately the 12%. The reason I assume 12% here, because I want to show you the table. I want to show you the table, that's all. You can use 12.29. Examiner got many answers. They got many answers. Okay, so not to worry. So we now go to this one here. It is now this figure, discount. I assume it is a 12%. So this 12% using formula, it is a nominal cost of capital. Nominal cash flow discount by nominal cost of capital. Okay, so if you look at the platform, now I show you, the table is given to you, right? So this table here is given to you. Formula is given to you. And the present value table is given to you. Annuity table is given to you. A normal table not given to you. So I'm now going to show it to you. So if you look at this one here, you see below here, there are formula sheet. So you can click on this one here, and you will see the table is here. So formula, it is here. Formula here. All right, So then, of course, you go to the next page. It is another page of the formula, Black-Scholes model modified. And then, of course, followed by the present value here. And we are assuming it is 12%. So it should be here. Year 1, it is 0.893. Year 2, 0.797, and so on. Until year 6, 0.507. Just to remind you that there is a formula given here for coming up with the discount factor. Okay, 1 plus rate to the power of minus n here. Okay, you don't need this one here. I just show you so that it's confirmed the figure is correct. I just show you 12%. How? Very fast. So I use 12% to show you only. Okay, column C is always my year 0. So the factor is always 1. Okay, and then the year 1 should be just 1 over 1 plus 12%, 1 plus a rate. So you'll be just equal to this figure 1 here. You divide it by 1.12 if you want, 1.12. So you get the figure. And then after that is this figure divided by 1.12 again. So you can just copy and then paste until year 6. You check, it is the same figure. Year 6, 506, 567, and so on. It's the same figure. Okay, So start with year 01. After that, just take the one before, divided by 1 plus the rate. That is 1.12. And then after that, you just copy on it. You see how convenient it is. Okay, so of course, you can come up with the present value. So let's net out the cash flow in year 0. So equal to the sum from operating profit here until your working capital. And then after that, you can copy and then paste it to year 6. After that, you can have the present value. So that will be the net cash flow. You multiply by the discount factor. So then copy and paste it over here. And you just have to sum it up here. All your present value, you will get the NPV 247,977.
Could you redo the discount back?
Discount, okay.
Yeah.
Discount, So year 0 is column C, So it's always 1, it's always 1. So then you come to next year, the discount rate should be 1 over 1 plus 12%. Okay, yeah? So it should be equal to 1, this one, the one before. Okay, yeah? You just have to divide by 1 plus 12%. 1 plus the discount rate, or 1.12, or by 1.12. So then you have 0.893. Then after that will be this figure, you divide by 1 plus 1.12 again. Okay, 1 plus 12% again. So you can just copy this one, copy, Control C, and then Shift, go until year 6 and paste it. So you get the rest of the figure. Got it?
Okay, thank you.
Okay, yeah, very good. All right, yeah. So in the exam, I don't do it this way because yes, unless you are required. So later on, I will tell you when do you use this way, when you don't use this way. For this question, because they only ask me, is it financially viable? They only asking me, is it financially viable? They never ask me other things. Later on, when we go to mind map number 3, where we have the investment decision, we may have to find out what is the sensitivity. We may have to calculate the duration. Then we will use this way. All right, yeah? Otherwise, if they just ask me financially viable, I don't waste my time. I will very fast, I use NPV function. Okay, yeah? So if I just put it down here, I use an NPV function. I use an NPV function here. All right, yeah? So I don't have to need to come up with present value, discount factor, and so on. I just look at this net cash flow here. I just look at this net cash flow here. The one in green. Okay, yeah? So that will be my cash flow. So I use an NPV function just like IRR. So equal NPV, okay, yeah, open bracket, you put in 12%, the discount rate. Then you have a comma, you start in year 1, comma, year 1, year 1 net cash flow, this figure, until year 6. So that gives you the present value there. And this one, you just have to add on this one only, the year 0. So NPV function start in year 1. IRR function start in year 0. Okay, yeah? So this start in year 1, standard. So you just have to plus this one here. You enter, you should get same figure, 247 around there. So enter, you get 247,772. So you should do it this way in the exam. If they don't ask you other thing. So then you save precious time here. You save a lot of time here. So you get full marks. You get full marks.
I have a question.
Yes.
So at the very beginning of the problem, it says that the annual production of tools could be increased by 70,000 units per year.
Yes,
so
that's right.
Would that be okay for me to understand that the annual production of year 2 would be 70,000 of year 1 plus another 70,000? Or it is just like a constant 70,000 figure?
I will agree with you that you can interpret it that way. So if you interpret it as year 1, 70,000, year 2 is 140,000, right? Year 2, you increase another 70,000, right? That means it's
yes.
140,000. And then year 3 will be 210,000. So if you interpret it that way, that's fine. But you put the assumption there. That's fine. That's fine. But I think it's more appropriate to say that because you invest this equipment of 200,000, because you invest in the 200,000, then your production, because of this investment, So both interpretation, it should be okay. Actually, a lot of people interpret like what you did lah, huh? So I see there's a point there. So nothing wrong. You interpret that way. You just make the assumption and let the examiner know. Okay, yeah. So the argument is this, that if you put in 200,000 for the equipment, all right, yeah. So your production should be more than right now. Right now you have other equipment. So you add another one equipment. So this equipment should give you 70,000. So another year later, this equipment still give you 70,000. Another year later, still give you 70,000. So that is one interpretation. Because of this equipment, it is more than right now incremental. There's 70,000. So that is an interpretation that I gone through. But you have a point there to say that, okay, this equipment, year one, give you 70,000. And then year two, it give you 140,000. Okay, and then year three, another 70,000 more, 200,000 and so on. That I think is acceptable. But you have to make it clear that that is your assumption. That's your assumption. Actually, a lot of people ask me, is it like this? I say, can, no problem. Okay. So don't worry about how you interpret, because sometimes English, even ACCA, when they put it down, it's not too clear. It's not so clear. So it's acceptable. Examiner have got many answers. Examiner has got many answers. So not to worry about that. Okay, good.
And also another question.
Yes, please. I welcome any question. Yeah, very good.
Could you re-explain the part when you got the working capital that will get back at the year 5?
Yes. Working capital, Okay. This is also another part, working capital here, you understand this is 7% of the sales. This 7% of the sales, is it okay?
Yes, I got that.
That you understand, Okay. There's 7% of the sales, Okay. So let's put it this way. Okay, All right. So you have question that will be very good, very good, making the class also very interesting. And you're also helping your friend also, Okay. So we want to ask this one here. What is working capital? Maybe you've forgotten, What is your working capital? Okay. Working capital, if you remember, company, when they run the company, you have inventory. Is it okay? You have to invest in your inventory. Okay, and then you sell to your customer. So when you sell to a customer, they don't pay you first. You give them credit. So you have account receivable. You have account receivable. So you need some money to finance your customer also. And then you also have to keep some cash for your operation. All right, So what do we call this one here? We call this one here your current asset. Your current asset. Okay, So current asset consists of your inventory, your account receivable, and the cash. These are the common current assets. So of course, when you buy inventory from your supplier, you don't pay them also. Okay, they give you credit. Okay, they give you credit. So you have accounts payable. You have accounts payable. All right, This is your most common current liability. This is a common liability here. So how much do you have to come up with to finance your current asset here? Partly financed by your creditors. So it will be current asset minus your current liability. So that is your working capital you require. That is what we call working capital. So the question say that is 7% of the sales. 7% of the sales. So remember, actually, it's current asset minus a current liability. So let's go back. Year 0, you need this working capital, 4131. So of course, you must put in 4131. You must put in this figure here. Okay, and then come to 1 year later, your working capital increases to 42,000. That means year 0, you already put in 40,000 for your current asset, net your current liability. Now come to here, your working capital, you need to put in another 2,000. That is, this figure minus this one here, the difference is 2,000 something. And then next year will be this one minus one, it is another 2,000 here. So this is your working capital in year 0, your current asset minus your current liability. And then come to year 4, this is your working capital, 48,000. So come to year 4 or the start of year 5, it is 48,000 something, 48,000 something. So at the end of year 5, when you end the project, what happened? We assume you get back the cash. We assume customer pay you back. We assume you clear all the stock. That means you get back your current asset. And then you pay your supplier. That means you say what? You get back the working capital. Whatever working capital you put in, 48,000 here, you get back 48,000. Or whatever working capital you put in here, 40,000 you put in, this one you put in 2,000, 2,000 and so on, until here is 48,779. So you recover. We assume you get back from a customer, you clear the inventory, you get back your cash, you pay your creditors. Is that right?
Yes, it's all right. Thank you.
Okay, very good. So actually this working capital, and just now you asked 70,000 is a very common things that students forgotten, or whether forgotten or are not able to link together. That's why in your F9, they always say, at the end of the project, you get back your working capital. I will get your working capital. All right.
And what if in the exam we forgot that to add back at the end of year 5, like how much marks will we get deducted?
Okay. Working capital, say that it is given to you is 2 marks. I say 2 marks. Normally it's 1 mark only. Normally 1 mark only. Of course, depending on whether it's in question 1 or question 2. So if it's 1 mark, maybe if you don't put this one here, maybe just 0.2 marks. Only 0.2 marks deducted. And this figure, if you don't put in, of course, your NPV is not the same as 247, right? Never mind. You still get the, based on the one that you didn't put in, you still get full marks for NPV. So not to worry. And the cash flow also, you get full marks. So don't worry, present value also get full marks. So you just lose maybe 0.2 only. So small matter. Don't worry about, don't be too concerned about the correct answer. Okay, get most of your figure, you are fine. You are fine. Okay, unless you want to go for world prize winner. Okay, so otherwise, it's okay. A lot of people also miss out on the taxation delay of 1 year or so. That also they take away maybe 0.2 marks like this only. Not a big deal. The main important thing is they want you to know the main thing.